Hello everyone, welcome to another interactive session by AKC Capital. The topic for today is the changing landscape of alternate investments in India. I'm Aditya Chopra, founder and CEO of AKC Capital, and it's a pleasure to have Anunaya Kumar, President Sales and Distribution for 361 Asset in India. So welcome, Anunaya.
Thank you, Aditya. Thank you for having me on your show.
Great. So Anunaya, my first question to you would be, how do you see the growth trajectory and landscape changing for alternate investments in India and globally?
First of all, let me compliment you, Aditya, for picking up a very pertinent topic, because this topic needs a lot of awareness to be created among the investors and our partners. Now, since you've asked me a journey, let me take you back in 2005, when globally alternates used to be, or this, assets under management used to be close to $37 trillion,
Right.
which by 2023 is close to 120 trillion.
Right.
And as per the BCG's report, the expected number by 2026 is slated to be $150 trillion, which is the total assets under management.
Right.
If I look at the journey, 2005, 71% of those assets used to be under active. Alternates occupying close to 11 odd percentage. 2023, if I come back, the mix has really changed. Alternates are close to 18 odd percentage, and the one which is giving way is actually the actives. They have shrunk from 71 to maybe 48 percentage.
Okay.
The India story, if I have to look at it, is no difference. Because we still have an alpha market, India, the actives, as on 23 is close to 67 odd percentage even today. If I go a little deeper into it, mutual fund as a number on December 2023, if I have to look at a growth and do a check from 2014 at a 50 lakh crores of an assets under management for the mutual fund, the growth is close to 17 odd percentage. 30 odd lakh crores for a PMS is close to 14 percentage. CAGR. I'm talking about all the numbers since 2014.
Okay.
But the real push one can see is in the alternates, where in 2014 the asset size being less than 0.1 lakh crore has grown to almost 3.5 lakh crores in 2023.
Right.
But the difference is 80% of the occupancy of this growth has been highlighted by Cat 2, category. So that's the category which has almost grown by 80% of this entire growth.
Great. No, I think thanks for these inputs, and there are three key takeaways coming from the data that you shared. One is obviously the growth within the alternate space is coming in category 2 set of investments. So probably that's something where the investors are really, garnering a greater share of investments. And I think it's also a factor that in India, given that SEBI has higher, ticket size of 1 crore plus, so natural to assume that this is typically catering to inflows coming from the HNI, ultra HNI segment. But very interesting data, and I think for our audience here, I think more important is that India is a country today which is actually more on active management, right? While it would be fair to assume that passives are more of a developed economy phenomena. So I guess we'll see when we reach that over time, but this is fairly insightful.
Yeah, I think actually data do suggest that the growth of the alternate space, at least globally, has been pretty phenomenal.
So Anunaya, my next question to you is that if you see listed equities is a very important AUM component for 361 Asset in India. Right. So how do you see the growth of this segment going forward? That's question one. And the second thing would be that how do you use the SCDV framework to evaluate this same? Some thoughts on that?
Yeah, I think very correctly observed. If I have to look at our numbers as on September 30th, out of 85,700 crores of assets under management for the 361 asset, almost 46,500 is with the listed side. Approximately 25,000 crores is on the private equity. 9,500 crores is on the performing credit, and rest is in the real assets.
Okay.
So fair to say that listed occupies the dominant part. And as we go further, I think our focus on the listed is going to stay. Obviously, we would want to see every category do grow. Now, one of the successes for the listed space to do is a framework that the investment team uses very, confidently is the SCDB framework. And SCDB is nothing but it's basically looking at the two components, which is return on equity and the PAT growth, which are very, very critical components if you want to look at the wealth creations. Correct. So, if you go back on a BSE 500, the long-term average on both the components is close to 15%. So, what we have done is on the x-axis we have taken an ROE, on the y-axis we have taken PAT growth. And we have distributed this into four, boxes, with 15 being the magical number, because that's an average. That's a long-term average. Long-term averages for both the components. And the one wherein ROE and the PAT growth both are in excesses of 15, we call them a secular. So secular is basically the segment wherein the growth representation is excess of 15%, both on the ROE and a PAT growth. And very fair to assume that they are largely consumption-driven businesses and all, your banks, NBFCs, auto, so on and so forth. Just opposite to, diagonally opposite to secular, wherein the growth is sub 15 on both the components. We call them value traps. And value traps are again, dominantly, if you see, with few being exceptions, are largely the government-owned or a government-controlled kind of businesses. Well, situations can also be such that certain businesses do fall under because of macros and a micros which is beyond their control. But then that's the segment we call the value trap. Now, as a core strategy, whatever is the weight of secular in the benchmark, the portfolio will always be owning secular more than the benchmark. So we will remain overweight on secular, and that would come at a cost of going underweight on value traps. So assuming if secular has an X percentage in the benchmark, you will always see the portfolio having X plus plus. And likewise, if Y is the hold percentage or representation percentage in the benchmark, you would see the portfolio holding Y minus. That's a core strategy. Now let's look at the other two components. One is the component where PAT growth is pretty dominant. But ROEs aren't substantiating to 15 plus kind of a number. And I'm talking about the businesses which are asset heavy businesses. The debt component could be higher, like a capital goods, metals, mining, so on and so forth. So we call those as a cyclical businesses. And again, diagonally opposite to that are the sectors which are reasonably asset light businesses. Debt components are relatively low, and hence you are able to establish an ROE argument while PAT growth may not be 15 plus. We call them defensives. So what do we do is tactically we keep shifting our positions between defensives and a cyclical, looking at where the values are. Where do we see the I would say objective of investments are getting met. So we will keep maneuvering our position between that tactically. So this is the framework. To remain overweight on secular, underweight on value traps, and tactically keep shifting your positions between cyclicals and defensives. Now, this is a framework, but it also gives you certain messages. So, for example, if you diagonally, put the framework into two parts, and diagonally you are basically doing an ROE. So, ROE of more than 15 and ROE of less than 15. It's fair to assume that ROE of more than 15, basically we're talking about the set of companies where the growth arguments are getting established. And ROE of less than 15, we can say the growth arguments aren't as dominant as it should be. So now let's go back to what did I started off saying, that look, I am secular overweight, value traps underweight. So by DNA, I'm more growth oriented. But by virtue of me tactically shifting my position between cyclicals and defensives, I'm able to participate even if the orientations of the market are not so much growth oriented. By increasing my positions or going overweight on cyclicals, I'm able to participate in that frame of the market as well. And if assuming tomorrow the market starts getting more growth oriented, then I can under-own cyclicals and put overweight on a defensive. So by taking these tactical calls, I am able to participate in all the market cycles. And that is possibly one of the reasons that you will not be able to, color me with a style biasness. Because I'm able to participate in both the, orientation of the market. So I think that's the SCDV framework, one of the framework which is getting used by the investment team very extensively.
No, I think that's very insightful, and I think for our audience, the key takeaway here is that obviously there is no style bias, and depending on the opportunity in the markets, and if you see, especially the last 2 to 3 years, you've seen the value style really doing well, and then most of the strategies which were growth oriented took a hit, and it was a challenging time for most portfolios. I guess the message predominantly here is that when you don't have a style biasness, then you can rapidly maneuver your portfolio in line with market realities and opportunities. And in a larger framework, the portfolios would tend to gravitate or mirror the long-term average, which is exactly what it should be. And if I were to fair to assume, that also gives a little bit of stability and consistency to the portfolios in the long run, which otherwise may be a challenge.
So Aditya, I think all the information are in the public domain.
Yes.
You being a subject expert, I'm sure you're going to do multiple deep dives into
Absolutely.
every bit of a performance checks and all.
Good.
I think you have the answer. You can best check on
Yeah,
it. But yes, endeavor is to be as consistent as possible.
Great. Thank you so much. This was really a good input and really insightful. So Anunaya, which brings me to the next question. When I talk to my clients about their fixed income portfolios, so one thing which keeps coming in the discussions is performing credit as a space in alternate investments. How do you see this landscape evolving and going forward?
So this is in fact another very pertinent part of the alternate that you have picked up, which is the performing credit or a growth capital. So I think if you look at from a capacity utilization perspective, there is a need for capex plan kicking in, and this performing credit as a space is going to be a big contributor, in terms of meeting the demands. Now it is happening on two counts. One is the demand part is moving up because of obviously China plus one factor playing a role, your capex plans kicking in playing a role. So demand is getting robust. But on the other side, the supply mechanism, if I'm has to look at the conventional ones like banks, NBFCs, mutual funds. For various reasons, it could be the flight to safety, it could be the constraints, or it could be the regulatory changes on a taxation piece. The supplies one could see, is getting narrower and narrower, which is actually resulting into a gap between a demand and a supply, which is getting fulfilled by the performing credit space. If you would look at in 2005, while this space used to be less than 2% of the alternate side, actually in 2022 is close to 70%. So numbers also are quite evident of the fact that this side is growing. And if you're talking about economy looking robust, tailwinds looking pretty promising, then I would say yes, the landscape looked pretty constructive.
No, I think so. What I'm trying to infer from your point is that this is a space which is going to grow, and fair to assume that companies which do not have access to easy credit coming from traditional channels, say banks or NBFCs, then they go to performing credit to access this space for working capital or expansion. Am I right to assume that?
Oh, absolutely. As I said, with a gap between a demand and a supply getting broader and broader, so that only would mean that we look for the sources. And this is certainly emerging as one of the sources for mitigating that gap.
Great, and that's a great input for our clients as well. I guess end of the day, it's a risk profile, an asset allocation which determines the allocation out there. But thank you for that input. It's really great. So Anunaya, which brings me to the next question. So when you look at the startup ecosystem in India, needless to say, it's thriving, And if you look at some data, while I don't have the numbers immediately, but I think we are a significant contributor to unicorns which have come forth in the last couple of years. So my question natural is about private equity investments, which is so important for capital which is needed by these startups. How do you see this landscape going forward?
Well, I think you picked up the question in a very right way that, being a country which is looking at startups and all, this is one of the very key ingredient for them. Yeah. So let's understand the private equity landscape first. It starts right from the early stage funding to providing a growth capital, yeah, to look at the late stage funding. So at every stage of a growth, the need for the capital is there, and yeah, private equity obviously becomes one of the contributor to that, fulfilling that need. Now, India's own landscape last 4 odd years, if I have to look at, we have got close to $48 billion. Yeah. If I look at our own share in the APAC, what used to be 15% in 2018 has become 20% now. And whom are we extracting the share? It is largely getting extracted from China to us. Okay. Despite all of this, I think our share as a penetration to GDP is minuscule 2%. When I look at America or Europe, they're between 4 to 5.5%. So, so there's a long way to go. Mm-hmm. What is certainly helping us, if I look at the average deal sizes, those are going bigger. Mm-hmm. As in 361 asset, if you look at ourselves, we manage close to 25,000 crores of assets across these strategies, right from the early stage to the pre-IPO. So this space is growing. This space is growing by all means. The need for capital is there, and with more newer ideas, because at the end of the day, as much as more innovative can you be in your approach to doing the business, is where the new startups starts getting generated, and that's where the private equity have a role to play. So yes, there is a huge potential and a long way to go.
No, I think that's a great input, and clearly this is an asset class which is probably, as I infer from you, would continue to grow going further. And you've highlighted 2 key points. The deal size or the average penetration vis-a-vis developed economies is probably half, right? You talk about some numbers, 2%, and in developed economies like 4 or 5% vis-a-vis the component of GDP. And another interesting component for our viewers here is that the deal size has undergone a massive change over the last couple of years.
Just keeping one thing in mind, people do normally get confused, okay, on the liquidity aspect.
Oh, okay, great.
So in a private equity, when you come in, okay, it's very important at what stage are you getting in the fund.
Yeah.
Because the moment you are in the early stage, then longevity for you to hold the assets become that much bit longer. Yeah. Vis-a-vis if you're coming at a pre-IPO or a late stage funding.
Okay.
So what you need to understand, the key risk, one of the key risks rather I would say, in the private equity is also the liquidity risk.
Yes, absolutely.
While people do get excited looking at the multipliers, on the investment that they have been able to derive, but it all comes at a cost of the liquidity risk. So earlier you enter, longer you have to stay. Later you enter, shorter you may have to stay. But still, even for a pre-IPO or a late stage, I think 5 to 7 years is a desirable, I would say shelf life that you should have in mind for a fund.
No, and that's so pertinent. And the 2 key takeaways here are clearly, you mentioned, to reiterate, the liquidity risk. Obviously, the time horizon, very, very important for clients to understand that as part of the portfolios and asset allocation, you got to look at a certain time horizon when you're coming on to these investments. And as long as that is in place, I think the portfolios are good to go. But again, a very useful insight, and definitely this is useful for our investors. Thank you so much. So Anunaya, great conversation so far, and I was just trying to see what could be the next 2 questions I should be asking you. And one key question which comes to all our investors and clients' mind is about passive funds in India, which seem to be more like a developed market phenomena, but slowly catching up in emerging markets, including India. So what's your view on the same? And maybe if I can add another question, and as we build up this conversation, is that when you look at 361 asset in India. How is it different from other traditional firms? Some views on that.
Okay, so let's talk about passive first.
Yeah.
I think in my initial comments I did mention, if I look at globally, the passive, as much as alternates are dominating the contribution to the global AUM, passives are also playing a very significant role.
Yeah.
And there is an estimation that by 2026 this number should be close to 26% globally.
Okay.
India still is a minuscule number.
Okay.
Now passives can be done in two ways. One is that you actually take an index hugging approach.
Yeah.
Whether through an ETF or an index, you
Right.
take an index hugging approach. But while doing so,
Right.
you are taking into account all these stocks which are a part of the index.
Okay.
Now, other one to do it is to play a smart beta approach, which is to
Right.
have some factors in mind. You
Yeah.
could be having whatever factor, like a momentum, value, whichever way you feel like.
Okay.
You pick up the factors. Based on the factor, you build a strategy. And when you do that, what you end up, gaining is weeding out those stocks
Okay.
which you do not see should be the part of the portfolio. So rather than taking into all the index stocks, all the stocks which are a part of the index,
Yeah.
you are able to select few,
Okay.
which you would want your clients' money
Okay.
to participate in those
Yeah.
ideas. So that's the difference. One is the smart beta, largely run by the factors, so on and so forth.
Yeah.
One is doing nothing, just pick the index
Yeah.
and then mirror it and just see to it that your errors are minimal as much as possible,
Yeah.
the retraction error. So that's where the passives have a role to play.
Right.
You in the India, if you see, you have both these strategies available for the clients.
Okay.
Only thing as an advisor, you need to be little bit more aware of, even if I call it a passive, is there any way that I am using my discretions?
Okay.
That's the only differentiator. So for example, you will see someone saying it's a passive, but I'll keep 20% as a discretion for me to
Yeah.
actively consider any change.
Okay.
So that can build in some kind of deviation. Plus and minuses I don't want to get into, because everything has a pros and a cons to it.
Right.
But if you are looking at a passive, then one way to look at passive is let it be completely passive.
Okay.
To an extent that I don't want to use my mind even for active weight allocations.
Okay.
So I'll make a portfolio equated.
Right.
Just an example sake.
Yeah.
I'll make a portfolio equated. I will not touch the portfolio for next 6 months, even if sky falls. So these are the certain ways of demonstrating your passive approach. That come what may, I think certain part of the portfolio I'm not going to change,
Okay.
while I'm using all my discretions for the actives that I'm managing it. So there are multiple ways of participating, and as an advisor, I think I leave that discretion with you.
Yeah.
What you feel is better for your client to look at.
Right.
Now getting back to the second part of the question, which is how as a 361 asset, are we different from any other traditional mutual fund or a asset management company? I would say one of the key differentiator is the skill sets that we bring in. Whether you talk about listed private equity, performing credit, or real assets, we have the distinguished CIOs with their own teams looking after each other's strategies. What it does is it helps you build a very nice ecosystem, whereas knowledge flows from each of the strategy heads, or either the CIOs, can play a very pivotal role in the decision making when you are doing it. Because see, a debt guy is going to look at from a different lens, an equity guy going to look at from different lens, a private equity guy going to look at from a very different lens. So when all the lenses come together, and that is helping in terms of building the portfolio, I think the ecosystem plays a very, very pivotal role. And that's one of the very key differentiator that we do bring in when it talks about this entire strategy is getting managed. Second thing is, as a house, I think we have been very, very clear in our mind. Let me give one example. On a mutual fund, SEBI has given you categories, distinguished categories under which we can launch the funds. I don't think that we are going to occupy all of them. So we will want to keep it we'll want to keep the strategy in such a way that with a lot of clarity stays with the partners and through the partners with the clients on the positioning of the funds. See, bottom line is, endeavor is very clear. Our endeavor is to build as much of consistency in performance as possible, and not to demonstrate excessive hunger for acquiring assets. I think with that kind of a clarity in mind, I think we are pretty clear that we would want to focus on the fund's management style and trying to bring value for our investors with a clear-cut endeavor, as I said, helping build consistency as much as possible. Well, it's not in no one's hand, but endeavor is to deliver on that.
I think that very well said. And if I can just, summarize the key points, there's a lot of data which you've shared here. I think for investors, I think clearly it's very clear that passive investments and funds are growing in India, and you talked about factor-based investments, smart beta and all. So obviously, and you could have an amalgamation of these strategies to, bring more depth in the portfolios. That's one. And that clearly seems to catch up as we see today. And also on your overall thing, one key takeaway which I'm looking at is that knowledge sharing, within the firms, how you actually do your business in India, knowledge sharing between key stakeholders, which probably leads to much better decision making, which is very important. And
one thing, Aditya, see, somehow I do feel as we progress further.
Okay.
See, we do asset allocation.
Yeah.
So as an advisor, when you go to
we do that all the time.
So asset allocation is the key to alpha creations.
Yes.
Not the timing and all of that.
Absolutely. Yeah.
What do you do that? Today you go with an asset allocation saying that, look, you should put the money in equity. You should put the money in fixed income.
Yeah.
You should put the money in real assets. You should put the money in commodity, which is the gold, silver.
Yeah.
You should also leave some part of the money for the alternates.
Yeah.
That's the broader categorization that you do.
Correct.
That's what my assumption is.
Yeah.
It could be more than at your this thing. I have a view that within equity, the time is not very far when you will also say, sir, within equity also you should have an actively managed fund.
Yeah.
And a smart betas.
Well said.
That is something which is evolving. I don't think my friend Aditya has any more a choice. This is getting deeper and deeper, and as you would see going forward, I don't think we can keep ourselves way away from the global growth trajectory, and that only would mean that the passives are going to have a role to play.
Yeah.
And as I said, within equity, I wouldn't be surprised that when you will say certain part of the money should be in active and certain part of the money should be in a smart betas.
Yeah, and I think for investors and for advisors, distributors, I think the key message is, I think the whole thing about asset allocation, which seems to be such a commonly used term, I think the next frontier probably is that how do you finally start dissecting each asset class further and in the right framework vis-a-vis the client goals. And I think an advisor or a distributor globally who's able to comprehend that would clearly be able to differentiate vis-a-vis the competition. So the message is that because the different asset classes are coming over time, you talked about equity, you talked about fixed income, understanding the nuances of that and communicating the same with the client is clearly the next step. Am I right on that?
Oh, absolutely. Bang on. Can't be more clear on that.
Great. So Anunaya, which brings me to the next question, is that post-COVID, if you see really, healthcare as a sector has really got everyone's attention, right? And it took actually a COVID for us to realize that. Now, if you see over the last couple of years, you've seen a lot of consolidation happening in this industry. There are a lot more investments, private equity funds who are coming in this space, especially in India. And I was also looking at some statistical numbers. Our healthcare spend as a percentage of GDP is far below compared to developed economies. So clearly there's a lot of room to grow. How do you see this landscape going forward in India? That's question number one. And if I may just add another question to it, within 361 asset in India, would you like to discuss any particular product launch coming in the next couple of quarters? Over to you.
Sure, I think we spoke on a private equity space, and healthcare certainly has one of the occupant of that space, and rightly picked up by you. It is emerging very rapidly. If I had to look at healthcare, I can possibly put it in 3 buckets. Healthcare service providers, technological setups, and the life sciences. What we are noticing is you have the companies which are pretty much focused on women orientations, IVFs, and all of that. You have the strategies where people are looking at AI solutions, orientation for the diagnosis. You have the CDMOs, you have the APIs. So this is no more a space, which used to be conventionally seen in the past, where you have the drug manufacturer or a hospital beds and all. It has really moved ahead with technology and AI playing a very pivotal role in its growth. Now, if you would want to participate in the new emerging theme or a new way of looking at a healthcare, then you will have to look at a private equity space, because I'm not sure how many companies are really in the listed side. And that's where, if you see the healthcare as a theme on a private equity is emerging, because investors are looking forward to capitalizing at the early growth stage. Rightly, another point that you made, if you see the contribution to the GDP coming from this, healthcare segment, it is still minuscule. And that only talks about the opportunity or the how big an opportunity can really become as we go forward. Now it's a compounding effect. One is new emerging themes. Other one is this can really become very big. And the third and the most important thing is awareness. After this COVID episode, I think the diagnostics, the people's own way of looking at the health aspects has seen a massive change. And that's all contributing to this space looking better. Now, second part of the question, which is to talk about the newer launches. Yes, I think we on the mutual fund side have got a SEBI approval to launch a multi-asset fund. We feel, that for our advisors, when they would go back to the clients, well, I think they are very comfortable taking a fund which is more on a multi-asset wise, because it takes away the load of an advisor and let it the managers who should take a call, how much of an allocation should be done in equity, what should be in commodity, what should be in debt. So it's a great asset allocation strategy, and we feel that yes, there is a need for us also to be having a fund in this space, and hence I think that's one fund which is in the pipeline. We should launch maybe in a quarter or 2. That's the only fund that we have in the pipeline.
Thank you, Anunaya, for your time for this interactive session today. Really grateful to you and the firm for making this happen. Looking forward to working with you. Thanks once again.
Thank you, Aditya. I must say that a good job done in building awareness, on this side, because this is much more needed. And we are pretty happy to partner with you in every possible way.
Great. Thank you once again.